Hi, good morning and welcome to another Boutiques on Wednesdays. My name is Tanya Thompson. You're not joined today by Eugene Bragg. Eugene is unfortunately traveling this week, doing his quarterly investment committee report backs. But today I'll be just guiding the session today that we'll be sharing. Today joining with me is Tavanga Shebesne from Boutique Investment Partners. Boutique Investment Partners is our sister company, DFM, that we has been specializing and doing a number of due diligences over the years with a number of our boutiques. And as you know, this Boutiques on Wednesday session, we do like to showcase a number of our top managing boutique fund managers. And Tavanga definitely does have a good relationship and understanding with 361 because we've known them since probably the inception of their business. So Tavanga, I'm not going to take too much time while you just get your camera ready. Just what Eugene always says, local equity markets, very volatile, as well as in the global sense. So today you guys are definitely going to be touching on that. Also, we saw such a big strengthening of the rand over the past week, over like 1.5%. So it's going to be really interesting just to see where you guys are navigating together with Matthew, just to see where you are in the local equity markets, and where our listeners can get some insights. Over to you.
Thank you, Tanya. Thank you so much for the lovely introduction. Good morning, Matthew. How are you doing this morning?
Morning, Tavanga. Yeah, happy to be here. Thanks very much.
Yes. So we have Matthew with us this morning, commodity analyst at 361, also the core portfolio manager of the 361 equity fund. He's got quite a lot to share with us this morning. And I think it's also quite a great opportunity to talk about pretty much, I think, one of the most attractively valued equity market, at least on a high level beta basis in the world right now. So let's see what that looks like. Matthew, over to you. And I think I will join you soon after your presentation for a few questions. Please feel free to post all your questions in the question and answer box. I'll do everything I can to address as many of those as possible. Over to you, Matthew. Thank you.
Perfect. Thanks very much, Tavanga, for the introduction, and thanks very much for everyone for taking the time today. I'm just going to share my screen there. So look, I think we're just going to start on just talking through a couple of things that we find interesting in the market at the moment, a couple of key themes that are influencing our decision making, and just how we're looking at positioning going into 2024. I think I think we've spoken about it a lot, and I think a number of people have spoken about it a lot in terms of commodity demand, and commodity demand for new age metals from this energy transition, whether it's copper, lithium, nickel, and cobalt, but not a lot is spoken on the supply side, which is half the story. And I think what we've seen on a number, we've seen a lot of diverging paths for a number of commodities recently on the supply side. And I think if you look at something like lithium, it's actually quite an abundant resource. If you look at a lot of the lithium, finds and discoveries and the high quality ore bodies that have been found in recent years, they've been found in mining friendly jurisdictions, Australia, Canada, places like Brazil. And I think because of that, you've seen a lot of development capex and a lot of development of lithium go into the market over the last couple of years. And we expect that to continue in the near term. So even though you have a pretty rosy demand outlook for lithium, we actually think the market's going to be oversupplied with the capacity coming online in the next couple of years. I think if on the flip side, if you look at something like iron ore, which, doesn't have, the energy transition demand profile, but you've seen over the last 5 to 10 years, there's been almost no development capex in iron ore, which has sustained higher prices. And I think if you think about a number of other commodities, that aren't really part of the energy transition, such as coal, for example, you've seen very similar trends in terms of a lack of development capex, which has led to higher prices, at least for the short to medium term. I think if we flip to, a commodity that we think actually has a extremely good demand profile, and we also think it has a decent supply profile, and that's copper. And why does copper differ from, something such as lithium? It's actually, if you look at, the discoveries of copper have been very limited, and the high quality ore bodies that have been discovered have been in high risk jurisdictions. So I think if we look around the world, there's been no real discoveries, of tier 1 assets in Australia, not in Canada, even in your copper jurisdictions such as, Chile and Peru, there's been a very limited number of discoveries. your discoveries have largely come from countries such as the DRC, Ecuador, there's one in Papua New Guinea, and there's quite a lot coming out of Argentina at the moment. But, mining companies are extremely apprehensive to invest in, greenfields projects in these sort of countries. So how mining companies decided to get that copper exposure, they've decided to buy existing assets. And, even though the demand picture looks extremely rosy going forward, you haven't seen that step up in, development capex over the last couple of years in copper, because there just isn't those ore bodies that people want to develop in low risk jurisdictions. I think also just a comment on PGMs. It's been a roller coaster of a ride over the last 5 years. A large portion of the revenue was from platinum 5 years ago. That obviously flipped to palladium and rhodium. We're back to platinum being the majority revenue driver for these companies, given the decline in palladium and rhodium. And I think if we take a step back, what drove up palladium and rhodium prices was increased loadings 2 to 3 years ago in places like Europe and the US. And I think what you've seen in recent times is people expected, the East and in particular China to follow on with increasing those loadings. And I think if you look over the last 2 years, you've seen zero increase in loadings in China. And you've also seen them pushing battery electric vehicles a lot harder. And we don't think this trend changes in the near to medium term. We don't think China's that concerned about stepping up loadings. So you're not going to get the delta there. And, obviously there's been a big push for China in particular for a number of reasons, which I'll touch on later, on why they're pushing battery electric vehicles a lot harder than the rest of the world. So we actually think it's extremely unlikely that you are going to get a recovery in some of those metals without a supply response. And, the market's quite concentrated. So if we look at, the platinum market in general, you've got the 4 main companies in South Africa, you've got Norilsk in Russia. It's unlikely you're going to see a supply response from Russia. So ultimately, it has to come from South Africa. You've got a few high-cost mines in South Africa, which you can probably take out, but ultimately the supply response has to come from North America. That's largely Stillwater, which is Sibanye's mine, and Impala Canada, which is obviously Impala's mine. So we think you have to see a restructuring at the very least, or these mines put on care and maintenance to try and rebalance this market. So ultimately, when we think about positioning in the PGM sector, we want to be exposed to those PGM miners, that don't have to be part of the supply response, that will benefit from the supply response. So that's your Northams and to a lesser extent, Amplats. And I think even if you look back at 2017, 2018, you had quite a big, quite a deep bear market in terms of PGMs. We think the market's fundamentally different now, and we think the supply response does come a little bit faster. Obviously, the demand outlook for things like palladium and rhodium were better in 2017 and 2018. And, at that time, the companies were focused on PGMs. You have, Sibanye more focused on lithium, copper, zinc, nickel, a number of the new age or the green metals. And you have even Impala looking at copper assets in Botswana. So we think the focus has shifted from some of these companies to green metals. And ultimately, they do need higher prices in the PGM, and their PGM assets faster. So we do think you see supply rationalization a lot faster than you did in the previous cycle. I think maybe just switching over now in terms of, what we're seeing in Africa. We are extremely concerned about some of the jurisdictions, and obviously Africa is a big region for a number of South African companies. You've seen a number of devaluations in a country such as Nigeria. The exchange rate's gone from 460 to around 800, but that's only half the story. Actually, what's happened is that the currency should have been devalued further, but for a number of reasons, they decided to try and peg it at around 800. But actually, if you want to take money out of Nigeria, you can actually only take it out at a much higher rate, which is the official rate, which is 30 to 40% higher than the exchange rate quoted on Bloomberg, for example, or by government official agencies. But ultimately, as a South African shareholder, obviously you have the devaluation. A lot of these companies have cost bases denominated in other currencies, such as dollars. So that is a squeeze on your margins. But we think it's actually even worse than that, because they can only take money out at these higher rates. And for us, as a South African shareholder, the money that you can get the money out of another country and repatriate it is actually the money. And that's, to us, is what the value of the profits are. So, over the next 6 to 12 months, we expect to see, some strain on a number of companies' earnings. I mean, you've got Vodacom, just quite big exposure to Egypt. You've obviously got MultiChoice, MTN, Standard Bank to a lesser extent with exposure to Nigeria. And there's a number of other countries, you know, that are having currency issues. I think Zimbabwe is very well known. There's also been an extremely large devaluation in the currency in Angola. And we think these are going to have a knock-on effect of companies' earnings over the next 6 to 12 months. And it's going to be an extremely tough time for them. So for us, you know, over the next 6 to 12 months, we are looking to largely stay away from companies with Africa exposure until we see some sort of stabilization, or at least you know, some sort of trend of the unofficial rate getting closer to the official rate, you know, in some of these major countries. I think maybe a slightly more positive note, if we look to South Africa, I think, you know, in previous calls, we may have shown this before on where we think load shedding will be in 2025 and, you know, our scenario analysis on that. Obviously, a negative number means there will be load shedding. So if you see, you know, negative 2.95 there, that's effectively, you know, level 3 load shedding. And if you see a positive number, it means we have an excess supply of electricity. I think if you've over the last couple of weeks, very positively, the energy availability factor is ticked over 60%. So I think if we can stay above 60% and, you know, we go into 2025, given the supply that's coming online, we actually think we'll have no load shedding in South Africa if we're able to stay above that 60% into 2025. And I think just from a demand perspective on electricity, I think something we found quite interesting. If you look at, you know, Europe also went through an energy crisis, slightly different to ours, obviously due to the Russia-Ukraine war. You know, you had a tick up in, you had an extremely big spike in natural gas prices, which obviously curtailed a lot of production. You know, people, you know, couldn't afford those prices, so they used less natural gas. But I think what we thought would happen is as prices came down over the next 12 months, is we thought that demand would bounce back. And if anything, it's actually got worse and it's got lower. And look, some of that is obviously European macro, but a portion of it is structural. Some companies, you know, learn to be more energy efficient. I think consumers learn to use less electricity. And I think if we think about South Africa and, you know, taking it back to home, you know, we went through significant periods of stage 6 load shedding. And I think companies obviously didn't want to burn a lot of diesel. They learned to be more energy efficient, and even consumers learned to use less electricity. So when we're going into next winter, we actually think you're not going to see a big spike in demand back to, you know, pre-COVID or pre-stage 6 load shedding. We think some of the, you know, decline in demand will be structural and will be permanent. So, you know, we could go into next winter, you know, with slightly lower demand. You know, if we could stick around 60, you know, we should have lower levels of load shedding in 2024. And then in 2025, hopefully load shedding is a thing of the past. And then, you know, obviously the other SOE that's of concern to us is, you know, Transnet. It's obviously a lot further back in its journey of improving. And I think everyone knows the problems there. You know, I mean, I think we've seen in the news with copper cable theft. You know, we've seen in the news with ghost trains, corruption, all those sort of things. But the big issue with Transnet for us is underspending on CapEx. And it's got worse and worse over the years. And ultimately, you know, that's been a function of the, you know, the position that Transnet's got itself in from a debt perspective. They just don't have the money to fund CapEx in the business. But I think we've seen a very interesting and a very good shift in government policy over the last few weeks in terms of Transnet. We've obviously seen things, you know, and policies around third-party rail. But I think something very important, which was what happened at the budget last week, was the fact that Transnet didn't get a bailout until they've actually implemented these reforms. So I think that's very important. And I think, you know, if these reforms are implemented correctly, you know, and I think they have to be, because Transnet, you know, obviously needs a bailout to survive. But I think over the next 6 months, you should see third-party rail, and hopefully in 6 months' time, you see some of the private sector running on Transnet's rails, and you should see a marked improvement in volumes to port, which is obviously beneficial to a number of, you know, companies within South Africa. But look, it's not going to be easy. I think, you know, a big issue in South Africa is locomotive availability, which takes 18 to 24 months to deliver a locomotive once it's been ordered. But, you know, there's a few small wins that could happen in the interim. There are some excess locos in South Africa held by the private sector. Transnet might lease a few, and I think that plugs the gap over the next, you know, 12 to 18 months before these locomotives start hitting our shore and you start seeing real improvement in Transnet. But I think it's on the right path. And then I think just, flipping to China and our view there, I don't want to speak too much on the property sector. I think, everyone's well aware of what's happening with the property sector, and it's been extremely depressed. We have seen some sort of stabilization, but I think, China's gone on a new path, and they're not going to stimulate property like they did. It's the law of diminishing returns, and, every single time it had less impact on their economy. And I think they've gone to the point now where, they're not going to just throw the kitchen sink at property again. So ultimately, China has three options to try and plug this gap that's been left by property. They can increase exports, they can provide new technologies and sectors. That's like, battery electric vehicles, artificial intelligence, green energy. And, the other option is for them to stimulate consumption. If they do neither of these three things and don't stimulate property, Chinese GDP is just going to trend in the same direction as what happened with Japan, and you're just going to go into a decade of 1 to 2%. And I think China are very aware of that, and I think they don't want to fall into that trap. So there's a big focus for them to trying to shift their economy. I think the least likely to happen in terms of China and in terms of shifting their economy is to increase exports. I think a lot of countries have now realized, particularly in the West, that they have an over-reliance on China. And there's been a big nearshoring theme and trying to disintermediate some supply chains from China, to make sure that, they're not as reliant on China as they were before. So I think it's going to be extremely tough for China to try and increase exports to the rest of the world, in particular the Western world. So they're left with the other two options. And I think China's done an extremely good job in terms of new sectors and stimulating new sectors. In particular, you can see they've now become the leaders in electric vehicle production. I think that's why one of the reasons why they're pushing electric vehicles so hard and they've incentivized it so hard is to try and find higher quality growth to what they did in the property sector. Artificial intelligence is a little bit trickier from a complexity point of view, but there's obviously a lot of money being spent in that too, and with the same as green energy. The big problem with these sectors is that it's they're pale in comparison to the size of the property sector and the hole left by the property sector. So while it can fill some of the gap, and it is filling some of the gap, it's not filling the longer term, it's not going to be able to fill the whole gap left by the property sector. And that ultimately, leaves, China with one more lever, and that's to stimulate consumption. Chinese saving rates are obviously a lot higher than the rest of the world. There are some structural issues on why they're higher than the rest of the world. There's no real safety net for consumers. So, the Chinese people save more. And I don't think you'll ever get to a stage where, Chinese consumption will be similar to US consumption. But I think, China needs to push their economy to be, less property and infrastructure driven and more consumption driven. And they need to find a better middle ground to where they currently have. So there's a number of things they can do to stimulate consumption. There's obviously tax cuts. If you can stimulate higher wages, social security and things like that. But I think that's ultimately where China has to go to try and plug some of this gap. Whether Chinese growth can continue at 5% plus, we're not entirely sure. But I think, China at least wants to manage their growth, not at 1 to 2%. They want to be as close to 5 as they can. And, if they get to 3 to 4%, I don't think that's the worst outcome for them in managing the decline of this property or the popping of this property bubble. So when we think about positioning, we want to be more exposed to Chinese consumption now as opposed to the Chinese property sector. So that's more, NASPA's process as opposed to some of the diversified miners that we've had in the past. So I think just in terms of South African equity, fund performance and positioning, I think it's been relatively good over the last couple years. We've been decent year to date, 3.4% outperformance net of fees, and very happy with our performance over the last 3 years and over the last 5 years, and obviously since inception outperforming by 3% on an annualized basis. But I think over the last 5 years, what we've probably been most satisfied and happy with has been with the consistent level of our outperformance. We haven't had humongous years where we've been outperformed by 20% and then had extremely negative years. It's been consistent alpha generation on a calendar year basis, year in and year out. And I think that's probably what we're most happy with and what we're trying to achieve with the South African Equity Fund. I think, obviously a portion of our business obviously is hedge fund. And, with a hedge fund, you have to lower volatility and you're looking for the best risk adjusted return. And I think that filters through to the entire business in terms of trying to find, returns at the lowest possible volatility. just in terms of positioning at the moment, look, I think I've touched on some of the key themes. You obviously see Naspers Process as an overweight there. Grindrod's another company that's obviously benefited from, Transnet's inefficiencies, given some of its port and terminals infrastructure in Mozambique and South Africa. But we also think it's part of the solution in terms of rail logistics in South Africa. And rail logistics is very different to, road logistics, where, it's a lot simpler business model. It's a lot more technical. And there's only 3 or 4 or, a handful of specialized companies that can run rail logistics in the private sector in South Africa at the moment, and Grindrod being one of them. So we think they're a big beneficiary there. And then if you just look at our underweights, you've got things like Standard Bank, MTN, Sanlam also has a relatively big, Africa exposure given their recent JV. So, we're very apprehensive over the next 6 to 12 months, given the currency devaluations, and, are concerned that there could be further devaluations in terms of, staying out of a lot of companies that are Africa exposed. And then, just on other things, so we're relatively underweight resources at the moment. We've been significantly overweight in the past. I think that's largely bottom-up view, underweight diversified miners, given our view on Chinese property, and, underweight PGMs, given our view on what's happening in China in the EV sector, and given, we don't think loadings are going to tick up there. And then, been rotating into quite a few defensives within the portfolio. Obviously, British American Tobacco is a big overweight in the fund. There's been a lot of talk and a lot of, press about regulation in terms of British American Tobacco. We don't actually think, regulation is the biggest issue for British American Tobacco this year. It's actually been regulatory enforcement. I think if you look at what's happened in the US, there's been a ban on flavor disposable vapes, but even though there's been a ban, it's now grown to 60 to 70% of the total vape market are these illicit Chinese vapes coming into the US. So we think it's an enforcement issue. And once that regulation is enforced, British American Tobacco will be able to grow market share a lot more in the reduced risk product category, particularly in the US. So, we think it's a little bit of a timing issue on regulatory enforcement, but we think the regulation and the, what's happening with regulation globally in terms of the tobacco sector is relatively well known. This just in terms of positioning, we largely split 60% rand hedges at the moment, 40% South Africa or South African Inc. stocks. That's been as low as 20%, I think, last year. But we have been finding a number of attractive opportunities. We've spoken about some of them, like Grindrod. Bidvest is another one that should hopefully benefit from Transnet improving. Things like Shoprite and Astral Foods are companies that should benefit from Eskom and load shedding levels being reduced. And I think, we've given the portfolio a little bit more of a defensive tilt, in recent months. Obviously a high weighting to British American Tobacco. We've got a number of, gold stocks in the portfolio, and we've been selective in buying some property stocks in the portfolio. We've started adding things like Growth Point, Nepi Rockcastle, and Mass Property into weakness. And I think, we're giving the portfolio a little bit more of a defensive tilt as we were before, as we're a little bit more concerned. Over the last couple of years, I think everyone's been very focused on inflation. I think we're much more concerned over the next, 6 to 12 months on the growth outlook for the world as opposed to the inflation outlook. So, that's kind of how we positioned at the moment. I think maybe I'll just stop there. I don't know if there's any specific questions on stocks that we'll take from the audience or things like that, but let me just end it there, and I think we can head to Q&A.
Matthew, thank you so much for that. We covered quite a lot of things. The first question I have is from the audience. Tian Fari is asking about the percentage, pretty much trying to understand of all the vehicle sales in China, what proportion or percentage electric vehicles?
Sure. So at the moment, it's ticked up aggressively. Almost 30% of them, basically 30% of the market is now, new energy vehicles, and that's outstripped the rest of the world, or most of the rest of the world. Obviously you've got European countries that are slightly higher than that, but you've seen extreme growth in the new electric vehicles segment in South Africa, in China, and we expect that to continue. But that's not just the story in China in terms of their electric vehicles. It's not just their adoption of electric vehicles, it's the fact that they're now becoming net exporters of electric vehicles to the rest of the world. So it's not only taking away there, it's also taking away from the rest of the world, and they're exporting a lot of their surplus capacity at the moment.
Thank you so much for that. I have another question again from the audience. So thank you so much for the questions. Please keep them coming in. The question really is about trying to understand the underweight allocation that you have towards the banks in general, against the context of the great yields they have and good valuations they have.
Sure.
Maybe
So look, I
had a similar question running in my mind, and it really was linked to, you would think, with most consensus around South African equity valuations being really good, that managers would sort of struggle to have active positions, because it almost feels like that is synonymous with a lot of ideas that you almost had to run lot tracking error. So maybe I also have a question related to that, but I know maybe the first one was specifically on the banking sector. Yeah.
Sure. So look, I mean, our positioning's changed quite a lot in the banking sector over the last couple of years. I think we were running overweight banks, for the last 2 to 3 years. And that worked out pretty well for us. I think very recently we've cut back our positioning in the banks, and, our positioning cutbacks have largely been valuation driven. I mean, the two main cutbacks have been on Standard Bank, where we are concerned that, they're earning super profits from Africa, and we think that does moderate going forward. And the other one is on FirstRand. So when FirstRand ran up, into the mid 70s, we cut quite aggressively back our positioning there just on valuation grounds. We have started increasing our exposure again to FirstRand, in the low 60s here. So a lot of our trading around the banks at the moment, or in recent months, has largely been valuation driven, and we do think the banks are relatively attractive at these sort of levels, and we have been adding to our banking exposure. But a lot of the cutback in the banking exposure came at higher levels where we do think they were fully priced. And we are turning in the interest rate cycle. It does get significantly harder for banks going forward. And there are some things that are getting mildly concerning for us in South Africa on the tax side, where you're starting to get murmurings of potential tax increases for higher interest rates, and people who made super profits during COVID. I think SARS is obviously under pressure from a tax perspective. So in recent weeks that hasn't really helped our conviction in the bank sector going in to that budget, going into an election. So we're a little bit, we are very valuation sensitive at the moment in terms of the banking sector in South Africa.
No, great. Maybe still on banks, could you touch on I know, because I think within your SA Inc. area, you've got a holding in Nedbank, and quite a healthy allocation. Could you maybe touch on that whilst we're still on banks?
Yeah, sure. So I mean, look, I mean, we've started increasing our weight to Nedbank again. Obviously, they are most exposed, or one of the most exposed to higher interest rates. But again, it's just a valuation call for us in terms of the banks on a relative basis. We think, our valuation for Nedbank is around 240. At these sort of levels, it starts becoming attractive. But, the entire banking sector, over the last 6 to 12 months, we've been trading quite aggressively. We don't have, now we're extremely overweight ABSA for a number of reasons. Last year, we were very overweight FirstRand. And that just changes on a relative basis on how we see valuations at the time. So, if we have this conversation in 6 months, what our banking exposure will look like will be purely price dependent. It's not, we don't have a structural, long-term story on a bank like maybe some of our peers do, and we just hold that bank into perpetuity. We do a lot of trading in terms of the banks.
Lovely. You've got quite a lot of questions coming in for you, so the audience really love you this morning. The next one, I think, is around the luxury goods sector. So the question in particular is keen to know on your view around the valuation. So they're sort of acknowledging that the growth rates are possibly good, but then concerned that it's mostly all priced in.
Yeah, sure. So I mean, obviously, Richmond's the main thing in the luxury sector in South Africa. We were, and I think we've got two views on the luxury sector at the moment. Obviously, the long term, we do think there are structural winners. Longer term, we do think there are great businesses, but we do think that they also over-earned during COVID. So we've been overweight the luxury sector. currently we're underweight Richmond, in our funds. And we are concerned that they're over earned. We think you've got another 3 to 4 quarters, to kind of cycle through a very tough earnings period. You could see flat to negative earnings, as the world and as macro, gets worse. We do think you need to see some sort of normalization in earnings. And I do think you went way above trend in earnings. And I think, the next 6 to 12 months is going to be extremely tough for the luxury sector, but we are looking for attractive opportunities to get back into a stock like Richmond. We just don't think the earnings downgrades are done yet. We still think you've got at least another 3 quarters of a high base that we need to lap out of. So I think you've got time we think we've got time in buying back into the luxury sector. It's largely a timing story, but we do actually think luxury in general is a long-term structural winner.
Oh, great. Thank you so much. The next question is on small caps, and it's trying to sort of cover quite a few things. So I think the first one is just maybe for you to maybe explain their opportunity set, but separating the small caps with meaningful global earnings exposure from the ones that have got meaningful South Africa exposure, and sort of how you're looking at the two. And then the second part to that question, I'm happy to sort of give you the second part again later, is after understanding like how you differentiate the opportunities in those two different baskets, it's also quite keen on your capacity for the small cap opportunity set, given that what they believe are very good valuations currently. So it's pretty much a 2, if not 3 layered question.
Yeah. So sure, look, our view on small caps is obviously, dependent on which stocks exactly we're talking about, but just in general, the small cap sector has got cheap. But we think, there are structural reasons for that. I think, 361 as a business 10 years ago used to be extremely prominent in the small to mid cap sector. But, you had the rise of passive, and, you've seen a kind of a drain of liquidity from the small and mid cap sector. And, everything's largely happened in the large cap space over the last couple of years. And it's extremely difficult for us to kind of see that trend reversing in terms of passive and in terms of, this liquidity drain on the small and mid cap sector, which, does create opportunities in the small and mid cap sector. And I think that's why you've seen a lot of takeouts. I don't think in the public equity space, it's going to be extremely easy for a lot of these small cap companies to re-rate, just given liquidity constraints. I mean, when we look at a stock and a position, we want to be invested in something that we can both buy and sell. A lot of small caps, when you buy them, you are kind of married to the stock for the next 5 to 10 years, which is, it's not really part of our, the way we run things. We try to be as agile and nimble as possible. So, being exposed to the small cap sector, even though the valuations are there, is not really what we want to do. But if you look at the small cap sector over the last couple of years, I mean, what has actually unlocked value has basically just been takeouts. You've seen obviously the market get smaller, and these companies are attractively valued, but there's the marginal buyer for these companies in the public equity space is very limited. So you've seen a lot of takeouts happen, very low 4, 5, 6p multiple businesses. So when we think about small caps, we think about buying businesses that are extremely good and strong, but we know if we do buy a small cap, we are going to have to hold that small cap on a 3 to 5 year view. And to be honest, the only real, liquidity event you could get is if something is taken out. So we do watch that a lot and we do monitor it. But it is, it is an extremely tricky and illiquid sector to play in. So, most of our work is done in the large cap space. Also, we do find some attractive mid cap opportunities, but, liquidity is very important for us in being able to trade in and out of positions. So, the real small cap stuff is not really something that, is that attractive to us.
Thank you so much. Another question quite a lot coming in for you actually. So thanks a lot to the audience. Really appreciate that. The question wants you to address the healthy discount to NAV that you're seeing in stocks such as BCI and Remgrow. And there's a part of that question that almost also wants you to talk about those stocks in the context of the elevated yields, real yields we're seeing in South African bonds. So again, another 2-layered question for you.
Yeah, I mean, look, I mean, we've seen, discounts to NAV continue to blow out in a number of companies that have done nothing. I think, the only way to alleviate that is to crystallize value. And I think if we talk specifically on, companies such as Remgro, they've tried to do a buyback, but, it hasn't been that material. And, if you actually look at what's happened with Remgro is they've taken a number and, they're publicly listed companies, such as a Mediclinic, and they've bought it out. Distal's been something similar, and it's now in the private space. And effectively, what's happened globally in terms of, private companies is people don't actually believe the marks of those companies. So I think if you look at what happened with Mediclinic, we were investors there. I think it was, taken out at a 30 to 40% premium. But if you look at what happened in the healthcare space, from that point up until now, it's been an extremely tough space to be in. If you look at what's happened with Netcare, things like Life Healthcare. So actually, the value of Mediclinic has probably got lower. I mean, if you see some of the numbers coming out of, Distal, they were extremely profitable. But, some of the numbers now are looking at like, flat earnings growth, negative revenue in some of the cases. But we know that, Remgro and, are not going to mark those companies down as much as the public equity markets are going to mark that down. So the way we look at it is if Distal was still listed in South Africa, would it still be trading at, 160 Rand? And we don't think in this market, given what global peers, if you look what's happened to, Heineken, Diageo, companies like that, they've all come off materially. So, the actual valuation of Distal in Remgro's book, we think is incorrect. I mean, it shouldn't still be 160 and it should be lower. And I think you can make a similar argument to Mediclinic. So, you almost have to differentiate on what portion of that discount to NAV is just, a holding company discount versus what portion of that discount is people don't actually trust what the marks in the private book are. And I think, there's a portion to both of that. So, if they had to relist Distal, would it go at 160 Rand? Probably not. So I think a portion of that, I think the discount now is 43%. A portion of that discount is people don't trust some of the private marks, and a portion of that is, the holding company discount. On the holding company discount side, it's relatively simple for them to try and narrow that. I mean, they've got a number of publicly listed stakes and, First Rand, Outsurance, Discovery. They could easily place that and do aggressive buybacks, which they haven't been that keen to do in the recent past. So, you'll get a narrowing of the holding company discount if you do things like that. But I think a portion of that discount is definitely, concern around the, the private marks. Hoskins may be a little bit different, but it's again, a lot of the value derived in Hoskin at the moment is from their oil assets, and it's extremely opaque on how to value those oil assets. They haven't been marked up in the books. There's very limited, it's almost the company tells you on a need-to-know basis, and until there's value crystallization on the oil assets, it's probably going to trade at it's trading at less of a discount because people are placing a higher valuation on those oil assets. But ultimately for us, it's extremely hard to value those oil assets with the limited information the company's given us, and until they crystallize that value, for us, it's very hard to get a tangible value for Hoskin at the moment. So I hope that answers the two specific questions. And I mean, you've seen some sort of you've seen some improvement in some of the holding company discounts, for example, in Naspa's process. When you've committed to an open-ended buyback that will happen into perpetuity. So I think there are ways to lower the holding company discount, but I think some of it is this discrepancy between private marks and what the public equity markets actually value those stakes at.
I see. No, thank you so much for that. You actually, the audience is showing you so much love, so I'm going to keep on trying to get all the questions out to you. So I'm going to give you two questions at the same time. The one is back on the small cap topic, and I think what the question is trying to get from you is, would you exploit the small cap opportunity via an index rather than try to do stock picking? And if ever that happens, under what circumstances would that happen? And the more important part of it is also what I think factors would inform your position sizing if you do that. And then the second one, it's an easy one, I think. It's about giving your Rand view over the next 6 to 12 months.
Sure. Yeah, so look, I don't think we'd use an ETF to buy small caps, because I think ultimately what happens if you buy you buy an ETF, ultimately that ETF is going to buy the underlying stocks in that ETF, and vice versa. When you try and sell the ETF, it's going to have to sell those stocks, and I think the liquidity in a small cap ETF is going to be exactly the same as the liquidity in small caps. It's going to be extremely tough. So I don't think that's a strategy we'd look to employ. I think you see something similar, when you try and trade, the rhodium ETF or even the palladium ETF, is you've got an extremely large bid-offer spread, which means it's extremely hard to actually trade, when you want to trade and at the price that you see on your screen. And I think something similar would happen in the small cap space. If you did have a small cap ETF, it'd be extremely large bid-offer spread. So I don't think that's something that we'd look to employ. And I don't think, we've never used ETFs in the South African Equity Fund. And I don't think it would be a strategy in general that, we would employ. We have to be directly invested in stocks and shares. And then, sorry, just the second question was?
The second question was around your view on the rand for the next 6 to 12 months.
Yeah, sure. So look, I mean, we're going into an interesting period now where, we do think global rates have peaked. And obviously, when global rates have peaked and, start going down, that should be net positive for the rand. And I think that's kind of, what you've seen over the last week or two is it's largely been dollar weakness, which has, filtered through into the rand being stronger. Our big concern over the next 12 months is, we're not as concerned about inflation, we're more concerned about growth. The market doesn't seem that concerned about growth yet. But if the market does start getting concerned about growth and, recessionary risks, that obviously turns into a stronger dollar. So, in the interim into that period until, the market starts focusing on growth concerns, we think the rand should, be relatively well supported, obviously extreme geopolitical events, which, are possible, but it should be relatively well supported. But, the moment the market starts focusing on recessionary risk, it's obviously net negative for the rand. So, if you had to give me a 12-month view, I think, whether it happens in 3 months, 6 months, or 9 months, I do think the market will eventually start worrying about recessionary risks and growth concerns, which would be net negative for the rand.
No, thank you so much for that. There is a question around property, so in maybe 2 different ways. So the one is pretty much trying to establish if your allocation to Nepiwa Castle is a signal that you're starting to have more interest in that sector. And if there is a lot of interest, what else can we expect from 361 concerning local property? And then the second part is just a general sense of how you're interpreting valuations. I think they're sort of linked to each other.
Yeah, so look, I mean, property for us is very much on a stock by stock basis. I think we've obviously done a lot of work over the years in, distributable income, and what is actually distributable income and what isn't. So I think a lot of companies over the years, and they continue to do, is, property should be a very simple business. You make rent and you pay it out to shareholders, but, there's a number of other adjustments, with cross-currency swaps and all these other things that, companies are paying out more dividends than they should have been paying out. We do a lot of work on that to find what the true, distributable earnings should be, and is that getting paid out correctly. So we're very selective in the stocks that we pick. From a general macro perspective on property, we do think rates have peaked. We are at, peak pain for some of these guys. Everyone talks about higher for longer, but we do think, I don't think, or at least our current view is that interest rates aren't going to stay up for the next year. So you do have a decline in rates will obviously be extremely beneficial to property companies in general, which is why we've started looking at these property companies. But look, obviously, if we are wrong on rates and rates do stay for another year, it's going to be extremely tough for these property companies to refinance at these higher rates. So it will be extremely difficult. But, we are finding 1 or 2 attractive opportunities that we do think the risk reward is skewed to the upside.
Great, thank you so much for that. The other question is trying to discern or get you to respond to how 361 adjusts portfolio positioning in response to global capital flows, which I guess is quite important now when EM sentiment is so depressed. But they also want to understand from you are there moments where you have try to take a view on impact of local flows and how those also typically influence unlocking valuations in property. So again, broad question.
Oh, sorry, I just lost you there. Yeah, so look, so the way we look at, global flows, and I think we made the decision around 5 years ago, we went through a process change, and I spoke a little bit about, how we used to be more involved in the small to mid cap sector. And I think, we've realized that flows have continued and will continue to be more, concentrated in the large cap space. So I think in general, we try to stay where the liquidity is and where we consider the liquidity to be, just in a more general sense, than what we did 5 or 10 years ago. On the local front, it's been, it's extremely tricky on local flows. I mean, obviously you've seen a lot of, foreign money exit our market. You've seen a little bit more interest in recent times, we think, from foreign investors. But, a big focus for us has actually been, and a big driver of, short-term performance and short-term movements in some of the domestic share prices has been these index rebalances. You've obviously seen a number of different index rebalances on us this process, and that filters through to the rest of the market. You had a big gold index upweight earlier in the year. You've got a downweight coming up. You've got SWIX normalization towards the middle of next year. So there's a number of different index rebalances that has a big impact on flows in South Africa. So we do a lot of work on that, trying to pre-position for certain things and being able to make sure that we're not doing things on the last day and being able to understand that. But yeah, I mean, flows and passive flows and index re-ratings are a huge part of the market, in particular in South Africa, and it does make a big difference in our lives.
Matthew, I know we're running out of time, but I also don't want to leave out any questions from the audience, because they've been really great and supportive this morning. So I'm going to sort of fire 2 questions. They're probably my last 2 questions. So the one is just trying to understand how you were constructive on copper and iron ore, but seem to be underweight the diversified miners. So just sort of help them understand how you sort of bring those 2 together. The other question is trying to get your sense on the Israel-Hamas war, oil price, and inflation risks.
Yeah, so look, on the diversified mining space, I mean, you've obviously seen, higher iron ore prices for a number of years now, and, we are constructive copper in the medium term. I think ultimately what it comes down to, recently has just been valuation. The other part of the equation, is not just the metal prices. It's obviously, what's happened on the inflation front for these companies in terms of operating costs. And, the margin has actually decreased significantly for a number of these companies, given, the high inflationary environment that we've been in. So even though, you've seen relatively stable iron ore prices, copper's come down a little bit, but not materially. And, these diversified miners also have other businesses, like a Glencore has a nickel business, which is now basically loss-making. Coal's come down materially. So there's a number of other commodities that haven't helped. The inflationary pressures, have obviously increased, and valuations of these companies aren't attractive or as attractive as they were, 2 to 3 years ago when we were owning them. I think a number of these companies, on relatively, conservative price decks with double-digit free cash flow yields, some of them, I mean, in Anglo Americans, low single-digit free cash flow yield now. BHP 5 to 7%. I think Glencore with the decline is around 9%. So the valuations aren't as attractive as they used to be, particularly on the global diversified miners. I mean, what we have done recently is we have in the last couple of months, we did buy into stocks on the South African front. We bought a bit of Tungela, we bought a little bit of Exxaro, and we exposed to similar metals, valuations a little bit more attractive. But also, with a positive view on Transnet, we do think they have a volume story going into the next 2 to 3 years, which we think is extremely positive. Obviously, there's been quite a big uptick in those share prices in the last couple of months, so they've already got close to our fair value. But we did find more attractive opportunities in the local diversified mining space, or the local mining space, as opposed to the offshore mining space.
Thanks, Matthew. I see Tavonga actually just quickly dropped off the call. I think he might have just missed his connection, but I think you're just in time and we have finished all our questions. So thank you very much to the audience for posting. And we will be, just a very big thank you from our side in making the time, Matthew, this morning. We really do appreciate it. And thank you to Tavonga for managing those questions that are coming through. If you have any further questions for 361, Jackie will be able to assist you with any questions or getting you in touch with the team as always. And thank you very much. Then for our audience members, if you'd like to join us for next week, we'll be joining with Centaur Asset Management, and we'll be taking a few questions from them on their side. All the slides from today's presentation, of course, will be on our Boutique Managers website. That's boutiquemanagers.co.za, and you'll be able to get the recording of this session as well as the slides from today. So a very big thank you to Matthew and our audience members for participating and getting those questions through to our fund managers. We really do enjoy these sessions and engaging direct with the fund managers. Thank you. Thank you, Tavonga.
Thanks, Tanya. Thanks, Tavonga. Thanks, everyone, for joining today. Really appreciate your time.